The banking sector has been suffering a beatdown as of late. The S&P Bank ETF lost almost 15%. That just happened yesterday. It's the worst day in more than a decade, and it's down 30% so far for the year. Joining us right now for more on the carnage and what we can look for potentially as a signal for a turnaround, Marty Mosby, Director of Bank and Equity Strategies at Vining Sparks. Good morning to you, Marty. The big bank CEOs are all going to be headed to Washington tomorrow to meet with President Trump, who is likely to put the arm on them to extend loans to small businesses, potentially at even lower rates. So how should investors be thinking about all of this?
Well, the first thing is the market has this volatility, especially for the banks, built in since 2008. Since 2008, every institutional investor told themselves that they did not want to invest in banks when you went into the next recession. So any inkling that we're going into that next recession draws us down to levels that we're now seeing. This level of price to tangible book value is very similar to where we were in 2011, just coming out of the last Great Recession. So that's built into the market. This is a reaction that we've seen in 2016, in 2018, and now we're getting it in 2020. To put that in context, in 2018, bank stocks were down 22%. 2019, they were up 29%. And then in 2020, we're now down 34%. So right back to where we were kind of at the lows of 2018 at this point.
So, Marty, clearly, look, if you're a long-term investor and you're playing the long game, you have to imagine the banks are going to come back. The question is there more to go on the downside before we really get there or not?
Yeah, so what we have to kind of put in there is this wild card. We have a new accounting methodology called CECL that just came in. So when we talked about this last week, we talked about two cyclical events. One is interest rates. That's fully baked into the numbers right now. The market actually expects 20 basis points compression from where we're at, which would take us about 15 basis points below our low that we were at when rates were at zero last time. So that is already baked in. If you look at the credit side, that's really the dynamic that's going to change this and when that's going to change. So when we're looking at that, the CECL accounting methodology could actually make the credit losses look a lot worse because they're going to have to create this provisioning. So first quarter, we need to get through that. In the meanwhile, you want to focus on the financial sector, trust banks. You heard earlier, Northern Trust or State Street. You can look at Goldman Sachs or Morgan Stanley, which don't have that same exposure to this particular accounting methodology, which this will be the first quarter they're going through it. So that'll be
Marty,
something
beyond the exposure to the accounting, what I also want to know is the credit exposure, perhaps, to some of the energy companies that are going to be likely hit by the price of oil and others.
Well, we went through this in 2016, and you actually saw the banks perform really well. A lot of the pressure was outside in private equity firms that had overextended into the oil and gas industry, but the banks were the senior positions. So the banks actually positioned very well. If you look at what the market has on credit, we've already got priced in 100 basis points of increased losses. We didn't see near that in 2016 when the oil prices were exactly where they are right now. And if you look at the 100 basis points, that would exceed the recession that we had in 2000 and the recession we had in the 1990s. So the overhang that we're seeing on these valuations, which now has pushed the dividend up to 4.5%, is basically completely predicated on what happened in 2008.
Hey, Marty, when you look at what's happening in Italy right now, where mortgage payments have effectively been suspended, is that right, Joe?
That's the headline.
There's some reporting from Reuters and others. Is that something that you think could come to the United States? And even if it doesn't, is that something you think that could cross Europe? And if that does, in terms of just market efficiencies and a structured market between our relationship between U.S. banks with banks in Europe, what's the impact?
Well, I'm here in Orlando today at the ICBA conference where we're talking to community bankers across the country. You just talked about the large banks going and talking to the president. What we need to be focused on is how do we help our businesses and our households through this process. So if we have to give up some earnings, we have to have something that's going to happen to our charge-offs in the short period to get us through a period of time when there's economic disruption. That's really what we're talking about down here. What are the decisions that can happen that can really help the economy kind of make it through this period of time? That's what the banks can really be focused on and can make a difference.
And talking about that, and we got to run, Marty, but real quick, what are you expecting the president to tell these bankers tomorrow and the impact of that?
Again, it's going to be disconnecting from the market for a period of time where you're going to have to be focused on a bigger picture. It's not about quarterly earnings, which is why we're saying we can't run into this thing before we get into April and we get some information about that. But it really is going to be, how can we help the economy? How can we help these businesses that are going to be at risk because we're going to have this economic disruption for a short period of time.
Okay, and finally, Marty, if you could own only one bank, which one would it be?
Yeah, so I think right now it's got to be Morgan Stanley. The recent acquisition got significantly discounted, so they already had that discount in. Now what you have is the discount from what we're seeing in this financial impact. And then what you will see is the trading gains and the activities with all this movement in the market can generate some revenue. So I think that's a good one right now.
Marty, thank you very, very much.